Hey, what's going on, cash flow hackers? It's Chris with Life 180, and in this video we're going to be talking about index universal life insurance versus whole life insurance, and ultimately looking at the current assumptions inside of each when they're sold. Obviously, if you understand the process of selling an index universal life policy or a whole life insurance policy, you understand that a lot of times most agents, even though I'm not a fan of this, most agents will utilize illustrations and the ledger in the illustrations, i.e. the spreadsheet, and I'm going to show you a little bit of this just to kind of give examples so you have clarity and you understand what's going on. But they use this ledger and they use the current assumption category, the current assumption column, to sell you on why you should put your hard-earned money into these products. And while I'm a huge believer of whole life insurance as a foundational asset, I do think it's important to never view it as an investment. It's more of a savings alternative. It's more of a place to keep your safe, liquid, accessible capital to be able to create opportunity for yourself, for your business, for real estate investing. It's a great place to keep your emergency fund, things of that nature. I'm going to tell you right now, whole life insurance is never an investment. It can make your investments better. I've done a lot of videos on this, but index universal life is sold primarily on the context that it is a great tax-free income vehicle in retirement, right? That is why it's sold as a retirement planning strategy to get to retirement, take income at retirement. And what they do is they sell you based on these projections, and one of the projections that they utilize is what's called the current assumption column inside of the illustration. This video, I'm going to show you why the current assumption column in IUL is not to be trusted, but why the current assumption column in whole life insurance, while it's not guaranteed, is at this point in time more trustable than ever. And I would even gauge to say that while there's no guarantees, once again, I'm got to be really, really aware, and I'm going to say this statement now fully knowing that I'm going to educate you how it works, so by the end of this video you can come to your own conclusions. But I'm fully confident in the policy that I'm buying for myself, that whatever I see on paper, I actually think that it could outperform it. So that's why I'm a huge fan of whole life insurance over index universal life insurance, especially right now. All right, so that said, let's just get into this and I'm going to show you. Let's start with index universal life and we're going to go from there, okay? So basically, here's the deal. I'm going to go back to the beginning and just show you. This is a policy that was sold on, or this illustration, I should say. This is what the policy was sold with. Sold on July 11th, 2018, okay? So now we come into this and we obviously have the in-force illustration I'm going to show you, which the in-force illustration is basically saying, all right, based on how things have changed over the years, how is this policy actually going to perform from here moving forward? What are their projections? A lot of people just lean on the statements of where the policy is, and the statement will tell you how much cash you have in the policy, but it doesn't give you any projections based on how the moving parts, the levers inside of the policy that the insurance company can change. It doesn't take any of that into consideration. So that said, what I'm going to do is I'm going to erase this real quick, and I'm going to talk to you about this real fast. So basically, here's what we have. We have the S&P 500. Remember, they say you get upside potential due to your participation in the index, right? So the S&P 500 point to point. They have an illustrated rate on this illustration of 6% and a maximum permitted illustration rate of 6.54%. And the 30-year historical average here is 7.43. So I can see this sales conversation right now. I'm like, I wasn't there, obviously, but I can hear it. The agent would be like, you know what, Mr. or Mrs. Client, the 30-year historical average for the S&P 500 has been 7.43%. We're participating in the index, but because of that, you're going to get a cap rate. And that's a beautiful thing, because when you index these strategies, you get the cap rate, meaning maybe back then it was, in this one it was 11%. So you have this cap rate of 11%. You can earn up to 11%, but you know what? On a down year, you can never lose money. So because of the fact that the 30-year historical average of the S&P 500 is this 7.43%, they're allowing us to illustrate 6.54%, meaning you can earn up to 11%, but you can never lose money when the market loses money. And so that 6.54% is a very conservative number. Once again, just a little caveat there. I'm not saying that's the way it works. I'm saying that's the way it's sold, okay? And then to take it further, this agent would say, well, you know what? I'm going to take it and make it even more conservative, because while I could illustrate it for you at 6.54%, I'm only going to illustrate it for you at this 6% number here, because of the fact that like I just want to show you a really, really conservative projection, right? And so, you know, then it goes down through this, and you could even see like, hey, if you look at this minimum maximum down here, this is showing like based on Monte Carlo simulations, basically like the minimum performance over the period would be 4.1%, and it could go all the way up to 8.27%. And so it's like, oh, okay, worst case scenarios, this is kind of what we're looking at, right? Now, one of the things that I want to do here to kind of elaborate on this conversation before going to the next page and showing you what actually happened in this policy over that 6.5 year period from when they bought it in 2018 to right now in 2024, when I'm filming this video near the end of 2024, you can see that the stock market in 2018 had a negative year, right, 6.24%, but then 19, 20, 21 had really positive years, a negative year in 2022, but guess what? The sale would be, wow, man, even though you had negative 19.44%, you'd be zeroed out in these years. So you'd have a 0 with indexing, a 0 with indexing, but then 11, 11, 11, 11, right? So that would be really positive, right? Like when you look at it, and if you look at the actual average over this period of time, it's 11.76%. And then you look at the year to date in 2024, and it's projecting even higher than this average. And so you would think that with all these assumptions, remember, this is the sales tool based on these quote unquote conservative assumptions that they're selling with. But then the problem is, now we go to the next page and the in-force illustration right here, the in-force illustration, and this is the same one, same policy. You look at the numbers here, and once again, I'm going to erase this just to work on it for a second here. But this point to point here, that illustrated rate is only 5.03%, and it's actually illustrated at the maximum illustrated rate. Remember, they illustrated at 6%, but they could have done 6.46%. Now, all of a sudden, that 5.03% is the maximum illustrated rate, and the 30-year historical average in this S&P based on the variables is 5.41%. Why is that? It's because of the fact that they've had shifts in the way that these policies actually calculate things, okay? So what happens is, inside of IUL policies, and this is one of the things I want everybody to understand, and I've done a lot of videos on this, but the S&P, a lot of people think that you are participating through investments in the S&P 500, okay? But really what's happening is you are participating, so that is true. You are participating, but you're never invested in it. Really what you're doing is you're buying call options with some of the cash value out of your policy, right? How does that work? Well, you fund your policy, you pay the insurance company, right? And so from that policy you fund, I'm gonna just write, this is your policy, right? So you get your policy. Out of the money of the policy, some of it goes to insurance, some of it goes to cash value. And from there, what happens is, you know, you're looking at this, it's like, let's say it's an $11,000 premium, and say it's a really highly focused policy on cash value. You know, the insurance is gonna cost you $1,000 per year, and the cash value you're gonna have, let's just call it, out of 11,000 total, just to keep it simple, we're going to have 10,000 per year going into the cash value, okay? So this seems really good, right? Like and through illustration of you know, on an illustration, this would look really attractive. But the thing is, here's how you actually participate in the index. This $10,000 is going to go, and you're going to get a return. This is going to really help us as we get to the whole life insurance conversation. It's going to create a return in the general fund. I'm going to just write GF, general fund, and that would equal basically $500. Okay? This turns into an options budget. Okay? And so when this turns into an options budget, what happens is they go buy call options. When they buy call options, that's the variable that we're dealing with. Is we have to think about what are the cost, number one, of the call options, and then two, what is our options budget? And so it ultimately doesn't really have anything to do, our participation in the index and the performance of this policy has very little to do, i.e. let me do this a different way. These numbers that you're seeing here, right here, these assumptions that they're going on have nothing to do with the 30-year averages at the end of the day. And this is proof, right? This reduction in this, because if I go back to here, you could see it was a 7.43%. The market has actually averaged 11.76 since that period of time. But because of the fact that this is happening, right? Because of the fact that really what matters isn't what the market does, but what does the options budget and the call options market look like? How does that impact our policy? You can see in the last 6.5 years, because of the reduction in cap rates and because of the fact that companies artificially inflate cap rates as marketing expenses to make them project and illustrate better, then they reduce those cap rates to more realistic assumptions over the years. Now you're looking at the fact that these are the more realistic numbers that you're dealing with, right? So now we were sold an 11% cap rate, now we have a 7.6% cap rate. And that is going to reduce the numbers. And so how does that play out, okay? And if you want more in-depth on how this works on a deep level, I've got other videos that get into that I think will help you, okay? And you can go check out my IUL Index Universal Life playlist, the 2024 playlist that I've got a lot of really good educational content. You can go check that out. I will put that playlist on the end screen and you can watch it. If you really want like a masterclass in understanding how this stuff works, that will be the key. So now what I want to do here is I want to show you what this impacts from a projections perspective. One of the challenges with Index Universal Life that I tell clients all the time is that the reason that they're so dangerous is because by the time you realize that you have a problem, it's already too late, right? It's already cost you. And so now what we're doing is we're getting back into this, okay? We're getting back into this. Original illustration, you could see it was run at 6%, okay? Non-guaranteed based on assumed interest, okay? So this is the non-guaranteed. This is getting to the entire point that I want you to understand, because what I'm going to do after I get done this, I'm going to pivot and I'm going to show a whole life illustration. I'm going to compare them side by side so you really understand the dynamics of how these two policies are nowhere near the same. They're so vastly different from each other and how they actually function. I think you're going to understand why I like whole life insurance a lot more. Because of the fact that this person was 39 years old when they bought it. The age isn't on there, but you could see 40 is end of age one, so that means year one, so that means they were 39 when they bought it. And they funded it. This is a small premium, but only $2,600. Net surrender value, 0 year one. But you could see that at the end of year 7, because this is the current, I highlighted year 7 because that's the current in-force year. I want to show this. It's $13,158. Now I'm going to go to the in-force illustration, okay? And year 7, right here, you can see right there, year 7 is $12,870. Not crazy, right? Like you can see, it's $300 less at that point in time. Not a crazy difference. So if you're a policyholder and you're just unaware of the internal workings and the levers that the insurance companies have pulled, and this is where I have some people that say, Chris, this is an in-force illustration. You should just get the statement. The statement shows you everything you need to know. No, the statement shows you how much cash you have. Okay, that's fair. But the statement doesn't show you the projections on what the actual policy will perform like here moving forward based on the levers that the insurance company has changed. I would argue statements are almost worthless unless you have an in-force illustration that goes along with them. They'll tell you that they reduced the cap rates and spread charges, and they've increased spread charges and reduced participation rates. They'll tell you that on the statement, but unless you really understand this stuff, like I can look at a statement and I can know what the projection will look like based on the fact that I've done this 1,000 times. But if you're a client that's never done this and you're looking at your own thing and you go, okay, some things have changed, my cap rates have gone down, but my cash value is pretty on point with what I thought I was going to have at this point in time. So, no harm, no foul, right? No harm, no foul. No big deal. My comment at this point in time is saying, hey, what we need to do is we need to look at what it projects going forward, because really the projections, the current non-guaranteed assumed interests, right, based on current charges and current returns, this is performing at a surrender value, right? This is the cash value. This is performing based on a certain result, based on the metrics that we're dealing with, the levers, like what are the cap rates, what are the spread charges, what are the costs of insurance, what are the other fees inside of the policy. And so I always tell people that they're going to reduce these, and this is nationwide. Like, this is one of the top sold products by all World Financial Group agents, and this is like something that almost every life insurance IUL carrier does, okay? So what we look at here is based on the net surrender value and what the projections are on the current. I want to go back and compare to the original, okay? So what I want to do, actually, you could see at year 7, like I just said, there's only a $300 difference. But because of the fact that if we go back to the original thing that I showed where it was run at 6% and now it's only 5.03%, based on the maximum illustration that it's able to do, imagine we're going back and this is the original illustration. Yep, this is the original. The way I know that this is the original is I can see the current assumed interest rate that it was created with was 6%. So that's the indicator that I can see. And what I want to do here is actually I'm going to go to the next page. And I want to get to age 70 right here. So age 70 right here on the original illustration that you bought was $142,000, okay? $142,000 based on this premium, based on the 6% assumption right there. So that is what it is. But now check this out. Age 70, based on the 5.03 assumption with this whole situation, age 70 is $96,000. So that is a huge reduction. That's $45,000 less. It's a 32% difference. Like, think about that, right? What I'm always telling people is you got to be prepared for this stuff. The reality is the S&P performance has nothing to do with the actual performance of your policy. This policy is a classic example showing how that's the case. I mean, if we go back here, just to kind of land the plane on IUL, and then we're going to go to whole life, just to land the plane on this, you can see that as I go through and I look at these numbers, and we showed, all right, they were illustrated with this 6.6% and with a max illustrator at 6.54%. The market did absolutely amazing overall, especially for indexing, because they'd be like, the argument for the people doing the indexing would be like, look, you get to avoid that loss, you get to avoid this 20% loss, so you have zeros on those years, but you have 11% every single other year here. That's an amazing thing. You'd have 1, 2, 3, 4, 5 11 years and 2 0 years. You average that out, that's going to be a really, really good number. And so that would be their argument for indexing, that you can't lose, and it would be awesome. But then the reality kicks in that even in those good years, because it's not the S&P 500 performance that has anything to do with your performance in the policy, it's the options budget, it's the options cost, it's the other variables and moving parts and levers. I've done videos on all the different levers. I'm not going to get into that in this video. That is not the purpose of this video. But I've done other videos that talk about the different levers that life insurance companies can move to impact your policy. And so that's really important to understand, okay, is to really understand the different moving parts and the different levers that they can move to impact the policy. I'm focusing on just this one element, and it's showing you how these things actually perform. This is the danger. When you bank on the current assumption, I showed you at age 70 for this person, they ended up having 35% less cash value. So what I want to do now is I want to go to another illustration for whole life insurance, and I'm going to do a little bit of a masterclass here on how this works for whole life insurance, because I think it's really important to understand. So As you can see, I've got markings on this because I've done other videos utilizing this illustration. This video specifically was on real estate, utilizing whole life insurance as a foundational asset, because you could see that I took loans from this and paid back the loans, and the whole purpose is to show the power of uninterrupted growth and how much wealth you can create by combining whole life insurance with real estate, and how much you can just reach financial freedom faster in doing so. But that, once again, is not the purpose of this video. The purpose of this video is I just needed to show one illustration that just shows how simple it is here, okay? So the non-guaranteed assumptions, right? So this is the non-guaranteed assumption right here in a whole life policy. There's two variables that go into a whole life policy with the variables as far as, is it going to perform according to the net cash value column that we see here? What forces, when we look at the whole life policy, because let's face it, most whole life insurance agents will still show you like, hey, look at the cash value you have in this column here, right? They're going to do that. So the question is, what leads to this column actually playing out the way that it's often sold, I should say. So the non-guaranteed assumptions, because that is not guaranteed, and then you see this little dash right here, there's guaranteed assumptions, okay? So now whole life insurance has, unlike IUL, where you have, you're participating and they're using call options to participate in the index, and you get the upside of maybe the cap rate and the protection at zero, and they say you can't lose except for the fact that you have some other fees and charges that go into it. The biggest thing that I can say with whole life insurance is that there's two variables, and I'm going to write them out for you right now. Variable one, oh, I got to shrink that. Hold on one sec. Variable one, oh wait, it's because I'm way zoomed in. That's what the problem is. So variable one is that you have that the insurance company pays a dividend. That's variable one, okay? This is how current assumptions work with whole life, okay? This is how it works. Number one, you're assuming that the insurance company is going to pay a dividend, and number two, the dividend is at the current rate every year. Okay, why am I saying this? Why is this important? Why is this really, really important to understand? Well, I just showed you how IUL is super volatile. It's all over the place as far as how it works. There's so many variables. You're not in control of how this works, whereas with whole life insurance, you're a partner with the company. If we look at the fact that whole life insurance IUL, Index Universal Life, if we look at the fact that Index Universal Life during the greatest bull run has been underperforming over the past decade to 15 years, what it was sold. If you look at that one policy that I just showed you as an example from 2018 to 2024, that is the classic, what I see every single day from literally 10 plus people a week that send me emails of illustrations and so on and so forth, okay? That is what I see. That said, there's a reason whole life insurance has a bad reputation by some people like Dave Ramsey or Susie Orman or something of that nature, right? Like people like that. Why is that the case? Well, this is the reason right here. Because first of all, we're assuming that the insurance company is going to pay a dividend and that they're going to pay it every year, okay? That's the key here, because this is assuming that it's paying a dividend every single year during this period of time, right? They're paying a dividend every single year. And in this situation, they're assuming, because when this policy was written, 5.2%, okay? That's what they're assuming the dividend rate is going to be, and that they're going to pay the 5.2% dividend, and they're going to pay it every single year to get to this rate. Well, the cool part is this dividend rate, since this illustration was made, has been increased to 5.7. So if I had bought this policy back when I made it, and this is a policy, I think from 2023, early in the year. So if I had bought this policy, year one would have been what it would have been, but then year two, I would have seen an increase at 5.7 for at least year 2. And then if the dividend goes up in year 3, year 4, year 5, maybe it goes back down. I don't know. But what I do know is that dividend rates right now in whole life insurance are the lowest they've been in 90 years. Okay. And so that's why I say to people, you can look comfortably at this column and realize like the current assumptions are based on the worst assumptions that whole life insurance has ever had in almost 100 years, almost a century, right? Now, here's where whole life insurance got the bad reputation, okay? And if you've watched this channel for any period of time, you're gonna understand where I'm going with this. But like, let's go to 1980, 2009, and then like 2024 here, okay? I know it's not to scale, but I think you'll get the concept. So interest rates, I'm gonna just go red for interest rates. Interest rates were at 19% in 1980. And they slowly went down, okay, to 0. And then they came up a little bit, they came back down, they came up, and now they're going back up, okay? That's where they are now. So like right now, like the Fed, and when I say interest rates, I'm talking the Fed funds, okay? Fed funds rate. And then we're at about like just about 5%, we'll call it right now for sake of argument. It could be a little higher, a little lower. I know Jerome Powell is trying to manipulate and reduce and change and whatever and control the economy and all that stuff, but let's just call it 5%, okay? What happens is dividends, now we're gonna say dividends are green here. Dividends follow interest rates. So dividends were here, they go up, and then they follow interest rates down. So dividends in say 1985 were like 12%. So the problem with that is if you bought a whole life insurance policy and you were thinking you were going to get 12%, well, what would happen is on the illustration every single year, obviously the numbers would have been way more inflated right here because they would have been assuming a 12% every year. Why? Because it's assuming that the insurance company is going to pay you a dividend, which, by the way, we only work with companies that have paid dividends every single year for 100 years. That's not the variable. When people go, Chris, how can you trust a whole life insurance company if you can't trust an IUL company? Well, we're dealing with companies that have been doing this for 100 plus years and they've always paid a dividend. When your IUL has a history of performing worse and worse and worse every year, and you're not partnering with the success of that company like you are with a whole life policy. So that just is what it is. The variable that impacts what the whole life insurance policies based on their illustrations are going to perform like is the fact that this dividend is at the current rate every single year. So if you go back to 1980, in 85, and 1990, you can see that if you bought these any point in time, like 1990, you're looking at like 11%. All the way to 2000, you're looking at like 9%. 2011, 12, they got down into like the 7% range, right? And they were just going down all the while during this, decade of 2009 and beyond. They were kind of stagnant. People were worried. This was also the boom in the IUL space because whole life companies realized we're going in this low interest rate environment, and they had to hit their guarantees, and that was more stress, and they could sell IUL and offset the risk and shift the risk to the policyholder. That's what they're doing. And so now what we look at here is at the current rate, this is the thing, this is the variable, the metric that matters. If we're looking at whole life illustrations like these, where the current rate was the lowest assumptions that we've ever had, in 100 years almost, well, it goes against us. And this is where whole life built that bad reputation. There were a lot of people that sold them based on 12 and 11%. And now if you sold it at 12% and then the next year it performed at, or maybe 3 or 4 years from then went to 11, then it went to 9, then it went to 7. And it's not that the company wasn't paying a dividend, because they were paying this dividend every single year, but they were paying it at current rates, right? And the projection was saying, hey, we're going to project it at this 12% every year. And I got news for you. If you saw the whole life illustrations at the 12% per year, it was pretty mind-blowing, right? Like the performance that they would have. It's obviously not how it works, but you have a lot of, I would equate whole life agents back then to the IUL agents now. They're selling on something that would never, come through for you. That said, the good news about whole life is that if you understand what you're buying over the past 30 years, whole life beat bonds. Okay? So if you look at the fact that we could have whole life insurance as a safe foundational asset that's liquid, like all the money in this category right here is liquid, you have accessibility to it, and that's where you could see in this example for real estate, I have loans coming out of it to buy real estate properties, right? And they're actually bigger loans. This is a net loan after paying some back out of the cash flow and stuff, because once again, this is based on a real estate video. But the bottom line here is when you look at this and you understand that whole life insurance is going to beat bonds over 30 years, you're going to keep the liquidity, you're going to pick up a death benefit, you're going to do all these different things. It's not the vehicle that you're going to create wealth with. It's not how you're trying to create tax-free income in retirement. It's a great bond alternative that could be a volatility buffer. If you understand 60-40 portfolio management and retirement to manage risk, this will take the place of your bonds as part of a greater financial strategy, okay? That is the reality that we're talking about. But when we get to the point of this video that I really want to land the plane home, and I know I have a hard time just staying focused because I think it's important for you to understand all these different things, but when it comes down to it, why can you trust whole life insurance, right? Why can we trust the current assumptions on whole life insurance and not index universal life insurance? It's because of the fact that the current assumptions in whole life insurance are super simple. A, they're going to pay a dividend every single year, and the companies we worked with have done that for 100+ straight years, okay? And so I trust that. They've shown a track record and history of success. The second part is the variable that comes into play. Are the dividend rates going to go up or down? Well, I look at it, we're at the lowest dividend rate we've literally been at. Right now, they just got elevated back up a little bit. But over the past couple of years, we've been at the lowest rates that we've had in nearly 90 years. And so when we look at that and then we compare all the moving parts inside of IUL and the fact that even if the stock market does really well, like I showed you in this example, the insurance companies still can reduce cap rates, they can reduce increase charges and do all these things. You are not in control of the results for the IUL. These companies will manipulate the numbers. They already manipulate the numbers right out of the gate based on having inflated cap rates, and they know that they're going to reduce those cap rates. It's just the way it works. And so for anybody that has any questions, comment in the comment section below. I'm happy to help. If you have an IUL policy, if you're looking to get a review or anything like that, we have rescuemyiul.com. I'll put a link in the description below. You can go check that out. And my team is happy to kind of take a look at it and kind of do an evaluation of a policy, kind of like what we did for the one that I showed you on this screen, and kind of like let you know what your options are, because I'm a big believer we don't want to throw good money after bad. We want to make the best decision from here moving forward, and that is what it is. If you're an agent that's looking to learn, go down below, agent.life180.com. You can click on the link and talk to somebody on the team about becoming a licensed agent on the Life 180 team. We are all about educating, all about teaching agents how to do this the right way. Super passionate about that, but hopefully you found value in this. Hopefully it makes sense. It's one of the reasons the people that are fighting against me with the IUL challenge, I just need them to understand it's not an apples to apples conversation. The products are not even in the same ballpark. They shouldn't be sold the same way. They shouldn't even be sold against each other, but they are sold against each other because of the fact that the insurance companies are kind of pitting them against each other. And the insurance companies that are selling IUL want you to buy the IUL over the whole life because they don't have as much risk and obligation. With whole life insurance, they got to meet their guarantees. With IUL, you have to meet your guarantees, and the insurance company can change the rules of the game on you along the way. So just think about that. Think about if you were to go into a business relationship, is that the kind of contract that you want with your business partner? So that's it. Hopefully you found value in this. If you did, like, share, subscribe, hit the bell, that way you're notified every time I launch a new video. Till next time, have a blessed, inspirational day. We'll talk soon. Later.